Now, I'm not suggesting that over the next 10 years, the price of gold runs 30-fold, because as an example, since the year 2000, it's already risen 13-fold.
Major banks like Goldman Sachs, Bank of America, Citi now saying gold's going to go 4,000 or 4,300, whatever they say. If you look across the roughly 300 trillion of investable assets, less than 0.5% of that is in gold. Get the hell out of credit, just get into gold or silver. It's the clearest sign that this is a credit bubble.
On a global basis, allocation to gold relative to other savings and investment asset classes, according to JP Morgan Chase, is about 0.5%. The 4-decade mean market share is 2%. Ownership reverted to mean, at least in the U.S. market. That would result in a 4-fold increase in demand for precious metals and precious metals-related securities.
20% of retirees are now working or return to work, according to the AARP, and 1 in 8 retirees said they're likely to go back to work in the coming year. Cost of living pressures as the top driver of that. And we also have an announcement from just last week from Morgan Stanley's Chief Investment Officer Mike Wilson, saying that now instead of a 60-40 portfolio, 60% stocks and 40% bonds that they had recommended in the past, they're saying that a 60-20-20 portfolio strategy, 20% gold, is a more resilient inflation hedge than a 60-40 portfolio, and says 60% equities for long-term capital appreciation, but 20% gold and silver, substantial dedicated allocation to a non-correlated hard asset. Rick, you said we should get to the bright point up here, and in the past you've said that sometimes it doesn't take a lot of a hedge to be an effective hedge if you pick the right one. So I'll let you take a first crack at that. These signs from officialdom that are finally people coming around to adopt what you've been recommending for some time.
Well, I guess I'm delighted, given that I'm positioned. I just think it's self-defense for the institutions. If you believe, as I believe, that in this sense past its prologue, that the U.S. dollar will lose 75% of its purchasing power over the next 10 years, like it did in the decade of the 1970s, and I believe that, I think it's reasonable to suppose that the nominal price of gold, when I say nominal, I mean U.S. dollar price of gold, will increase in a way that mirrors that. In the decade of the 70s, the last time the U.S. dollar lost 75% of its purchasing power, the gold price ran 30-fold.
Are you ready for retirement? Or will inflation, debt, and collapsing markets force you back into the workforce? Right now, banks like Goldman Sachs and Bank of America are quietly predicting gold prices of $4,000 an ounce and beyond, while Morgan Stanley is rewriting the entire investment playbook. But here's the shocking truth. Less than half of 1% of the world's wealth is allocated to gold. That imbalance could trigger one of the fastest and most violent shifts in financial history. If you own gold or silver, or you're planning for retirement, you cannot afford to miss this.
Now, I'm not suggesting that over the next 10 years, the price of gold runs 30-fold, because as an example, since the year 2000, it's already risen 13-fold. But I am suggesting that the increase of the gold price, the nominal gold price, may likely mirror the decline in purchasing power of the U.S. dollar. If that's true, the nominal gold price would increase 3 or 4-fold in the ensuing 10 years. If that happens, a reasonable allocation to gold can hedge a lot of the portfolio deterioration that you would experience in other parts of the portfolio. I want to say, too, that this isn't the only way up the mountain. I personally save in gold, but I maintain liquidity in U.S. dollars. There's a very, very, very big difference between saving and maintaining liquidity. I don't own gold because I think it might go up. I own gold because there's been a golden constant. If you save in gold, if you look at home prices, or if you look at grocery prices, or you look at anything in your budget, save tax, you're surprised at how cheap things are measured in gold in the period 2000 to 2025.
In real terms, gold has quietly kept grocery bills and housing costs in check for 25 years. Up next, he cautions against putting too much into gold, a mistake even cautious investors make.
I think, too, that it's possible to over-allocate to gold. I know that'll be travesty in this call, But I note in the decade of the 70s, in the middle of an equities bear market from 1968 to 1982, a 14-year-long bear market that both Alasdair and I were part of, the Warren Buffett, who believed that gold was a pet rock, generated 24 or 25% compound internal rates of return over time. I would suggest to you that gold is merely a component, albeit a major component, of the strategy that will get you through the next 10 years. Alasdair mentioned earlier that on a global basis, allocation to gold relative to other savings and investment asset classes, according to JP Morgan Chase, is about 0.5%, despite the blandishments of the Harvard endowment. The 4-decade mean market share is 2%. If ownership reverted to mean, at least in the U.S. market, that would result in a 4-fold increase in demand for precious metals and precious metals-related securities. I'm not smart enough to tell you what that would do to the price, but I think it would be interesting. Again, I had a phone call with a former client a couple days ago who is now 100% in gold. This is daft.
I mean, anyone looking at a pension fund is actually on a loss, or a loser. The only thing you can really do now is protect yourself against the declining purchasing power of currencies. And the only way in which you can do that is to buy physical gold. I mean, I would prefer ownership of gold rather than indirect credit through an ETF. And the other thing, I think, is to look at maybe some other commodities, because the one thing that's happening, which we just don't understand in the West, is that there's a whole world out there being run by, dare I say, China and Russia, are small enemies, but they basically are assembling the majority of the world's population, and they're going to industrialize it. And that's going to require an awful lot of base metals. It's going to require also gold and silver for monetary purposes. And so that's the area where you've got to look. And we haven't had any sort of move out of conventional investments into these defensive sectors. And that, I think, is going to be an interesting challenge, particularly when you understand that equity markets are basically being sustained by a credit bubble. I mean, just look at what's been going on with the leverage, if you like, the debt leverage through loans, to investors who have been leveraging up in order to improve their returns on, presumably on the Magnificent Seven or whatever. They're so greedy. I mean, the latest figures from FINRA looks. I mean, you're looking at over $1 trillion outstanding there. Now that's got to be unwound, and it will. I mean, it's a sign, if you like. It's the clearest sign that this is a credit bubble. And if you look at the behavior of investors, I mean, they're just chasing momentum. Who gives a damn about value? That's not the way to go. So it reminds me so much of the dot-com bubble back in 2000. So all the symptoms are there, the psychology and everything else. And then on top of that, we've got President Trump's beautiful tariffs. And I tell you, this just reminds me of 1929 when we had, the Roaring Twenties, which was the puffing up of credit, the credit bubble. And then you had the collapse from a high point, I think in September 29. Market lost 90%. And guess what? We had tariffs as well, Smoot-Hawley Tariff Act. That came in. The whole situation is so reminiscent of that. But this is far larger. This is a dangerous time. But at some stage, investment managers are going to realize they're doing completely the wrong thing. And I think it's just beginning. For example, you see major banks like Goldman Sachs, Bank of America, Citi Corp, whatever, now saying gold's going to go 4,000 or 4,300, whatever they say. But think about their poor clients. They haven't got any. I've been knocking on the door and saying, look, your analyst is saying gold's going to 4,300. What have I got? You've just got me the wrong bloody stuff. And this will be acute when that credit bubble pops, because I tell you what, it's going to be a very nasty scene in industrial equities, in tech stocks, and all the rest of it. And I don't know how much people will be able to get out, but at the moment, on average, if you look across the roughly 300 trillion of investable assets, less than 0.5% of that is in gold. They've got it completely wrong-footed.
Since the year 2000, gold has already risen more than 13 times, yet major institutions remain dramatically underweight. Historically, gold has averaged around 2% of global portfolios, but today allocations sit at just 0.5%. If capital merely reverts to its long-term average, demand could quadruple overnight. That's why Morgan Stanley has abandoned the old 60-40 stock-bond strategy and now openly recommends a 60-20-20 allocation, with 20% in gold and silver as a permanent inflation hedge. Wall Street rewriting its own playbook is not a small move. It's an admission that bonds no longer protect you. History is repeating. In the 1970s, the US dollar lost 75% of its purchasing power, and gold soared 30-fold. Rick Rule believes the next decade could mirror that cycle, not because gold is in a bubble, but because the dollar itself is in decline. Even a 3x or 4x move higher in gold would simply mirror the erosion of purchasing power. But here's the mistake too many investors make: going all in on gold. Rick Rule warns gold is a hedge, not a religion. Equities, even during tough decades, have delivered strong returns. Gold is best used as a stabilizer, a way to preserve wealth when currencies and credit systems unravel. And unravel they will. FINRA reports over $1 trillion in margin debt, much of it leveraged into the Magnificent Seven. This isn't growth, it's a credit bubble. The last time we saw this kind of mania? The dot-com crash in 2000, and before that, the tariff-fueled collapse of 1929. Both ended in brutal wipeouts. And it's not just markets. This crisis is deeply personal. 1 in 5 retirees in America is already back at work, and another 12% expect to unretire soon just to keep up with the cost of living. 2 years ago, advisors told clients they were safe on a glide path. Today, those same advisors are telling them to cut expenses, move homes, or find work. Meanwhile, Social Security, originally designed when life expectancy was just 66 years, is now drowning under $120 trillion in unfunded obligations. With only $5 trillion in annual federal revenue, the math doesn't add up. Alasdair Macleod issues a blunt warning. Pensions are broken, fiat currencies are collapsing, and ETFs won't save you. If you want real protection, hold physical gold and silver. Meanwhile, China and Russia are stockpiling metals, fueling both industrial demand and monetary leverage, while Western markets float on credit bubbles disguised as growth. The bottom line? The dollar's decline is inevitable. And when money rushes back into gold and silver, the move will be violent, fast, and unforgiving.
So I really think that the next few months, and I think it's that soon, the next few months are going to be extremely interesting from the point of view of the switch, if you like, away from, the current winners, which will become suddenly, like cyanide to investors, into obviously what's already running, and they just haven't bought it. So fascinates me that, look, I'm a fairly simple soul. I just say, get the hell out of credit, just get into gold or silver. Rick actually is more at the coalface, analyzing companies and all the rest of it. So that's probably where the leverage is on this extraordinary story at this moment in time.
You both mentioned retirees, and I wanted to read a couple of statistics to place this in context regarding, quote, working longer or unretiring for any reason. I had never even heard the word unretiring before. 20% of retirees are now working or return to work, according to the AARP and Investopedia. And in addition to that, a survey by Resume Builder found an additional 1 in 8 retirees said they're likely to go back to work in the coming year, and giving cost of living pressures as the top driver of that. And I can attest from the fact that we live in a 55-plus community that we have neighbors who said that they were retired, Their personal financial advisors said they're on a glide path. They have to make no adjustments as recently as 1 to 2 years ago. And now they're being told by their same personal financial advisors that if they don't cut expenses or get a job, get some form of income started up, or both, they won't be able to continue on. And one had to move out and go to a less expensive living area just in order to try to cut taxes, cut expenses. So any comments from either of you about the plight of retirees who thought and believed and were told and were guided into their current path that they're now being told, actually, no, things have changed. You got to get back to work, or you got to cut expenses. You got to change something up if you're going to remain retired.
Well, first of all, fire their advisor. Personal financial planning over time is a very long-term endeavor, but the arithmetic around it is fairly simple. The second thing is that talking to either Alasdair or myself about retirement is fairly foolhardy. Both of us have failed completely. It's important to note that when Social Security was instituted in the United States, its mandate was to provide basically poverty-style existence for people above the age 65. And the median life expectancy of an American male when Social Security was instituted was 66 years. Demographics has changed. And so it makes perfect sense that people would need to prepare to live longer. I don't recommend retirement myself. I enjoy working. Let's just say that my mind needs to be either stimulated or sedated. Working for me is much healthier than drinking. And the consequence of that is that I like to work. On a more serious note, I think that if you look at the solvency of various retirement systems, including Social Security, that you come to the conclusion that you need to take care of your own retirement. If you are American, you need to bear in mind that according to the Congressional Budget Office, the net present value of unfunded entitlement obligations in the United States exceeds now $120 trillion. This number doesn't come from a balding, fat, cranky old libertarian. It comes from the Congressional Budget Office. Now, to put that in perspective, gross federal income is $5 trillion a year. What do you think the probability is that the United States, and Alasdair will have to give the European or British numbers, but what do you think the probability is that the U.S. government, with $5 trillion in gross income, and of course a government and a nation to run, can honor $37 trillion in on-balance sheet liabilities and $120 trillion in off-balance sheet liabilities? Think about the arithmetic around this, and think about despite the fact that you paid into Social Security for 40 years, which is irrelevant, there isn't enough money to take out. Think too about some other form of retirement entity, perhaps private, that invested the bulk of their proceeds in 20 or 30 year debt obligations, yielding some number like 4, 4.5, or 5. Where the underlying inflation rate is 8. The managers are in for a tough spell. If they sell those low-yielding instruments, they take hits to principal down. If they hold them, they guarantee the fact that they can't fund their obligations over time. Talk about a rock and a hard place. So understand where you are, understand who you are, and plan accordingly. It's your only chance.
Let's be clear. By the time CNN or CNBC shouts, gold hits $4,000, it'll already be too late. You don't wait for the fire alarm to buy insurance. You prepare before the crisis hits. Rick Rule and Alasdair Macleod couldn't be clearer. Don't treat gold like speculation. Treat it like survival. Don't rely on paper promises. Hold real, physical gold and silver. And don't assume your retirement is safe just because Wall Street said so. If you care about your savings, your family, and your future, now is the time to act. Hit that subscribe button right now, turn on the bell, and join us every week as we uncover the truth behind gold, silver, and the coming financial reset. Don't be the last to know. And before you go, I want to hear from you. Do you believe gold will really hit $4,000 this cycle? Or does it go even higher? Have you already started protecting your retirement with gold and silver? Or are you still waiting? And here's the big one. Do you think the retirement crisis is already here? Drop your answers in the comments below. I read every single one, and your perspective might even be featured in the next video.